Do you know that in the summer of 1997, a financial crisis that began with the collapse of a single currency in a small Southeast Asian nation spread within months to engulf an entire region, wiped trillions of dollars of accumulated wealth from the economies of Thailand, South Korea, Indonesia, Malaysia, and the Philippines, toppled governments, triggered social unrest that left hundreds of people dead in street protests, and forced some of the most humiliating public negotiations in the modern history of sovereign nations with the International Monetary Fund? And do you know that the conditions that produced the 1997 Asian financial crisis, the combination of currency pegs, hot money inflows, over-leveraged banking systems, weak regulatory oversight, and the brutal speed of contagion in interconnected global capital markets, have not been definitively resolved, and that the crisis remains one of the most instructive case studies in what happens when the international financial system's assumptions about emerging market stability turn out to be wrong? This is not a story about distant economies or abstract financial instruments. It is a story about what happens when the rules of global finance, applied without adequate consideration of local conditions, produce outcomes that devastate the lives of ordinary people who had no part in making the decisions that caused the crisis. It is a story about speed, how quickly financial contagion can move across borders in an era of free capital flows. And it is a story about the limits of the models, both the macroeconomic models that the IMF used to diagnose the problem and the financial models that international investors used to assess the risk. This is the Asian financial crisis of 1997. And this video is not financial advice. Thailand in the mid-1990s was everything that international investors wanted an emerging market to be. GDP growth was running at 8 to 10% per year. The manufacturing sector was booming, fueled by export demand from Japan and the United States, and by a wave of foreign direct investment that had come from Japan, South Korea, Taiwan, and the West, seeking lower production costs. Infrastructure investment was transforming Bangkok and the country's major cities. A rapidly growing middle class was spending on consumption goods and financial products in ways that looked, to external observers, like the early stages of a sustained economic transformation. The Thai baht was pegged to the US dollar. This was a deliberate policy choice made to provide the kind of exchange rate stability that foreign investors and domestic businesses needed for long-term planning. When you borrow in US dollars and operate in Thai baht, a stable exchange rate eliminates one of the primary sources of uncertainty. The peg encouraged dollar borrowing. Thai businesses and financial institutions borrowed heavily in dollar-denominated debt because dollar interest rates were lower than baht rates, and because the peg made the exchange rate risk seem manageable. The underlying problem was that the Thai economy was, by the mid-1990s, running a substantial current account deficit. It was importing more than it exported. The deficit was being financed by capital inflows, foreign money coming into Thailand in search of high returns in real estate, equity markets, and high-yield financial instruments. As long as the capital kept flowing in, the current account deficit was sustainable. The inflows financed it, but the composition of those capital inflows was dangerous. Much of the money coming into Thailand was not long-term foreign direct investment in productive capacity. It was short-term portfolio investment, hot money that could leave as quickly as it had arrived. And a significant portion of the inflows was flowing into unproductive assets. Speculative real estate development, golf courses, luxury developments in Bangkok that the market could not absorb at the prices developers were hoping to achieve. By 1996 and early 1997, cracks were appearing. The real estate sector was showing signs of a bubble that was beginning to deflate. Several finance companies that had borrowed heavily offshore to fund property lending were reporting rising non-performing loans. Thailand's export growth had slowed, partly because the baht's peg to the dollar meant it had appreciated against the currencies of competitor economies in the region. The current account deficit remained large. The foreign currency reserves that the Bank of Thailand held were not as large as the size of the country's dollar-denominated liabilities. In late 1996 and early 1997, the first speculative attacks on the baht began. Currency speculators, hedge funds and proprietary trading desks at major banks began shorting the baht, selling baht they had borrowed against the expectation that it would have to devalue against the dollar. The Bank of Thailand initially defended the peg by buying baht in the foreign exchange market using its reserves and by arranging forward contracts with other central banks. The defense burned through reserves at a rate that the Bank of Thailand could not sustain indefinitely. By early July 1997, the Bank of Thailand had exhausted a substantial portion of its usable foreign exchange reserves defending the peg. On July 2, 1997, the Thai government announced that it was allowing the baht to float. The baht immediately fell. In the weeks that followed July 2nd, it lost more than a third of its value against the dollar. The dollar debts that Thai businesses and financial institutions had taken on became dramatically more expensive to service in baht terms. Companies that had borrowed in dollars but earned in baht were suddenly facing debt repayment burdens that their cash flows could not cover. The finance companies that had been propping up the property sector began to fail. The Bank of Thailand was forced to intervene to rescue the worst of them, eventually suspending 58 financial institutions. The stock market fell sharply. Confidence in the Thai economy evaporated with remarkable speed. What happened next demonstrated the speed and ferocity with which financial contagion can spread across a region when global capital markets are integrated and investor sentiment shifts rapidly. Within weeks of the baht devaluation, speculative pressure mounted on other Southeast Asian currencies. The Philippine peso, the Malaysian ringgit, and the Indonesian rupiah all came under attack. Investors and speculators saw in the Thai situation the same vulnerabilities. Current account deficits financed by hot money inflows, currency pegs, or managed exchange rates, over-leveraged banking sectors, weak regulatory oversight, and began moving money out of the region. The Malaysian ringgit and the Philippine peso both fell significantly by August 1997. The Indonesian rupiah held somewhat longer but came under increasingly severe pressure as the months passed. South Korea, which was further away geographically and which had a larger and more diversified economy, seemed initially more insulated. But it was deeply connected to the region through trade and through the exposure of its banking system. The contagion was not purely the product of rational re-evaluation of each country's fundamentals. It was partly driven by investor herding. The same investors who had piled into the region in the boom years now piled out together. The very interconnection of global capital markets, the mechanism that had channeled investment into the region during the good years, accelerated the exit during the crisis. For Indonesia, the consequences were catastrophic. The rupiah fell more than 80% against the dollar between July 1997 and the beginning of 1998. Companies with dollar-denominated debt and rupiah revenues were bankrupted overnight. The banking system, which had been poorly regulated and heavily connected to political and business elites through governance arrangements that reduced the transparency of loan decisions, was revealed to be deeply insolvent. Unemployment surged. Prices for essential goods rose sharply as the currency depreciated. In May 1998, food shortages and economic desperation triggered riots across multiple Indonesian cities. More than 1,000 people died in the violence. President Suharto, who had ruled Indonesia for 32 years, resigned. South Korea's crisis arrived in late 1997 and was, in some ways, the most shocking for international observers, because South Korea was considered, by 1997, to be one of the great success stories of the post-war global economy. It was a member of the OECD, the Club of Developed Nations, and its per capita income had risen from levels comparable to sub-Saharan Africa in the early 1960s to levels approaching those of Southern Europe in the 1990s. The transformation had been built on massive, state-guided investment in heavy industry and technology. The chaebols, the large diversified conglomerates like Samsung, Hyundai, and Daewoo, had become globally competitive manufacturers. But the chaebol model had a structural vulnerability. The chaebols were deeply leveraged. They had borrowed heavily, with debt-to-equity ratios that were in some cases 10 to 1 or higher. They had been encouraged to borrow by government policy and by banks that were, in many cases, effectively directed to lend to them. And when the regional financial crisis began to reduce the availability of international credit and to raise doubts about the creditworthiness of Korean financial institutions, the fragility of the Korean system was exposed rapidly. In November 1997, as Korea's foreign currency reserves fell toward the point where it would be unable to service its short-term foreign debts, the Korean government approached the International Monetary Fund for emergency assistance. On December 3, 1997, the IMF announced a $57 billion bailout package for South Korea, the largest in IMF history at that point. The Korean won had already fallen significantly and would fall further before stabilizing. Unemployment doubled over the course of 1998. Hundreds of companies went bankrupt. The International Monetary Fund's role in the Asian financial crisis is one of the most contested aspects of the episode, and the debate about whether the IMF's prescriptions helped or worsened the crisis continues to shape discussions about the design of financial rescue packages for developing countries. The IMF's standard prescription for a country in financial crisis is austerity, fiscal tightening, interest rate increases, and structural reforms designed to address the underlying weaknesses in the economy. The logic is that these measures restore confidence in the country's ability to service its debts, which allows the currency to stabilize and capital to return. In the Asian crisis, this prescription was applied in countries that did not have the kind of overheating fiscal deficits that austerity is typically designed to address. Thailand, South Korea, and Indonesia were not, before the crisis, running large government budget deficits. Their governments had, by emerging market standards, relatively sound fiscal positions. The underlying problem was in the private sector: over-leveraged banks and corporations, weak regulatory frameworks, and the sudden withdrawal of short-term foreign capital. The IMF's austerity requirements, higher interest rates, reduced government spending, fiscal surplus targets, were imposed as conditions for the bailout packages. Critics, including Joseph Stiglitz, who was the World Bank's chief economist during the crisis, argued that these conditions worsened the recessions in the affected countries by reducing domestic demand at the moment when the private sector was already in crisis. High interest rates, designed to attract capital back to the country by making local assets more attractive, also made domestic borrowing more expensive and accelerated the bankruptcies that were already occurring. In Indonesia, the structural conditions imposed by the IMF were particularly severe and politically destabilizing. The requirement to remove subsidies on fuel and food staples contributed directly to the price increases that triggered the 1998 riots. The political instability that followed the Suharto government's fall complicated the economic stabilization process significantly. The IMF's own subsequent evaluation of its handling of the Asian financial crisis, conducted in the years after the crisis subsided, was notably self-critical. The organization acknowledged that some of its conditions were poorly calibrated to the specific nature of the crisis in each country, and that the fiscal tightening imposed in the initial stages of the crisis may have been excessive. The recovery from the Asian financial crisis was, in some respects, remarkably rapid. By 1999 and 2000, the economies of most of the affected countries had returned to positive growth, and by the early 2000s, several of them, including South Korea, Thailand, and Malaysia, were growing strongly again. But the crisis left lasting changes. The most significant was the massive accumulation of foreign exchange reserves by Asian central banks in the decade following the crisis. Countries that had been forced into the humiliating position of borrowing from the IMF at the cost of their policy autonomy resolved, collectively and individually, never to be in that position again. They began accumulating dollar reserves on a scale that had no precedent in the post-war international monetary system. China's reserves went from relatively modest levels in 1997 to over $4 trillion at their peak in the mid-2010s. South Korea, Japan, Taiwan, and the ASEAN economies similarly accumulated reserves far in excess of what most economists would have regarded as necessary for exchange rate stability. This accumulation of Asian reserves, the savings glut, was one of the factors that contributed to the low interest rate environment of the 2000s and, indirectly, to the conditions that produced the US subprime mortgage boom and the 2008 global financial crisis. The crisis also produced lasting changes in how the affected countries regulated their financial systems. South Korea undertook significant reforms of its chaebol system and its banking sector. Indonesia strengthened its banking regulation and oversight. All of the affected countries tightened capital adequacy requirements for their banks and improved supervisory frameworks. These reforms meant that the affected economies were substantially more resilient in 2008 than they had been in 1997. The Asian economies were among the least damaged by the global financial crisis of 2008, in part because their financial systems were better capitalized and less leveraged than they had been a decade before. Malaysia's experience of the crisis was distinctive because its response was distinctive. Prime Minister Mahathir Mohamad refused to accept an IMF bailout and imposed capital controls in September 1998, fixing the ringgit at 3.8 to the dollar and restricting the ability of foreign investors to take money out of the country. This was, at the time, an almost universally condemned decision. The orthodox view in international financial circles was that capital controls were economically destructive, that they would deter investment and deepen the crisis. The IMF argued strongly against capital controls. International investors were alarmed. The result challenged the orthodoxy. Malaysia's economy recovered somewhat more quickly than might have been expected, and the capital controls were gradually unwound over the following years without the catastrophic consequences that many economists had predicted. The Malaysian experience provided ammunition for those who argued that the orthodox prescription of open capital accounts was not always optimal, that in specific circumstances, temporary controls on capital flows could provide the breathing space for economic stabilization. The debate about capital controls that the Malaysian episode generated has never been fully resolved. The IMF subsequently moderated its position, acknowledging that capital flow management measures might, under certain conditions, be appropriate. The question of how much capital account openness is appropriate for developing countries at different stages of development remains one of the most contested issues in international financial policy. The human consequences of the Asian financial crisis were measured in lost decades, not just lost quarters. Unemployment doubled or tripled in the most severely affected countries. Companies that had employed thousands of workers for decades went bankrupt within months. The savings of ordinary households held in banks that failed or in equity markets that collapsed were wiped out. The poverty rates, which had fallen dramatically during the long expansion of the 1980s and 1990s, rose sharply. For many families, the gains of a decade or more of economic growth were reversed in a period of 12 to 18 months. The generational impact was significant. Young people who entered the labour market in 1997 and 1998 in Thailand, South Korea or Indonesia encountered economies in recession rather than the expanding economies their predecessors had found. The opportunities that the pre-crisis boom had offered, the manufacturing jobs, the financial sector positions, the export-oriented companies, had contracted sharply. The disruption to career trajectories produced effects that lasted for years beyond the immediate crisis. South Korea's crisis produced a particularly notable social response. The government launched a campaign asking South Korean citizens to donate gold, jewelry, medals, trophies, to help rebuild the country's foreign exchange reserves. More than 3 million South Koreans participated, contributing approximately 227 tons of gold. The campaign was widely seen as a remarkable demonstration of collective sacrifice in response to national crisis, and as evidence of the depth of the social shock that the crisis had produced in a country that had regarded itself, with some justification, as one of the great economic success stories of the 20th century. The 1997 Asian financial crisis raised questions about the international monetary system that remain unanswered 3 decades later. The speed with which financial contagion crossed borders in an integrated global capital market challenged the assumption that economies with sound macroeconomic fundamentals were insulated from the problems of their neighbours. The brutality of the IMF's initial prescriptions raised questions about whether the standard toolkit for financial crisis management, developed in the context of Latin American fiscal crises, was appropriate for the different kind of crisis that the Asian countries were experiencing. And the accumulation of reserves that followed the crisis created the global imbalances that contributed in turn to the conditions that produced the next global crisis a decade later. The crisis is also a case study in the dangers of financial liberalisation, undertaken without the regulatory capacity to manage the risks that come with open capital accounts and integrated financial markets. The countries that suffered most severely were those that had liberalised their capital accounts and their domestic financial sectors in the years before the crisis, opening themselves to large inflows of short-term capital, without building the supervisory and regulatory infrastructure that would have been needed to prevent the over-leveraging of their banking systems. This lesson, that financial liberalisation requires equivalent regulatory capacity, was not new in 1997. It had been visible in earlier crises. It was learned partially by the Asian economies in the aftermath of 1997. And it was insufficiently applied by the advanced economies that experienced their own version of the same dynamic. Over-leveraged financial institutions, under-regulated risk-taking, the sudden withdrawal of confidence. In 2008, the 1997 Asian financial crisis was not the last crisis of its kind. It was a preview.